Hi, everyone, and welcome to today's webinar, or welcome back if you joined us on Monday as well for the Australian Fund delisting webinar. I said on Monday we wanted to keep that one fairly closely restricted to the delisting itself, and the same today, but in the other direction. If we can focus on what's been happening in the funds and what the prospects are for the underlying investments. If you do have any questions about the delisting, of course, send them through to us, but we will stick to the fund update stuff today. As usual, general advice only today. We do not take into account your personal circumstances. Please seek professional advice where necessary. Quick update from me, and I'll hand over to the team. I've got Alex Shevelev, Portfolio Manager on the Australian Fund, with me here today, and Harvey Migotti, Portfolio Manager on the International Fund as well. Hi, gents.
Hello.
I mean, the overlay from me, as I said in my quarterly report letter, small caps have started doing better over the past 6 months. They're still massively underperformed large cap stocks over longer periods of time, but the right sorts of businesses are doing very, very well out there. You can see on this chart a couple of our smaller cap stocks, one in the Australian Fund, which is Gentrack, a software company, and IBP in the International Fund. The share price is up really, really significantly over the past 12 months. And that's well in excess of what's happened at the Russell 2000 and the small ordinaries here in Australia. But it does show that if a business can tick the right sorts of boxes, there is plenty of investor demand out there for them. I've been saying internally to our own team and also to the management teams of companies that are still whinging about their share prices languishing at low levels, it's time for people to start looking at themselves rather than looking at the market in terms of appreciating that, because there are plenty of companies out there that are seeing their progress now being reflected in share prices. And we weren't seeing that so much 6 months ago. Harvey might touch on IBP later in this presentation, but some of these companies were doing very, very well and their share price not going anywhere. Generally, the companies that are doing well are seeing that reflected in their share prices now. So time for lack of excuses and more progress at the underlying level. Harvey, we're going to kick to you first. If you can take people through what's been happening in the International Fund over the first 3 months of this calendar year.
Yeah, it's been a solid start to the year for overall markets, and we'll touch upon that on the next slide, but also the fund. We're slightly lagging on a 3-month basis and slightly above on a 6 and 1 year basis. I think that's a pretty decent job. We're not thrilled. We'd obviously like to have outperformed more, but a lot of this has been driven by mega caps and the Magnificent Seven. Obviously, if you don't own NVIDIA, you've lagged to some extent. It's been a nice start to the year. Obviously, that was driven by, and we've touched upon this in our previous discussions, but a bit of a regime change towards the back end of last year as rates started going down and CPI in the US started softening. So that helped kind of people get back into equities and helped a bit of the rally since November. We're going to see that in the next chart as well. One thing to point out on this slide is the MSCI World small caps have lagged their overall MSCI World counterparts quite significantly, both on any basis you look at it, whether it's 5 year, 1 year, 6 months, or 3 years. So, some of these stocks, as Steve mentioned, are doing well, but the bulk of that cohort is still lagging behind as people have been rotating into, higher quality / more defensive assets, and you generally find them at the larger cap end of the spectrum.
I think really importantly on this slide as well, Harvey, that 5-year number in excess of the index, despite that small cap underperformance. And that is our job here, is to outperform the market over those rolling 5-year periods. And it's good to see that number back ahead of the index as well.
So it's been a phenomenal kind of 6 months, and even more so year to date through March for many international indices. Nasdaq's obviously been the big driver there, as you see on the top. Driven by the likes of Meta, NVIDIA, and tech names, other quality names. But everything's rallied, and generally stocks have performed reasonably well this calendar year. Obviously, April is a bit different. You've had some hotter inflation data come out in the US, so this is kind of trying to capture what we've seen till March, and that's the commentary that we're focusing on. But April is a bit more wobbly out there. There's been some profit taking and a bit of red over the last few days. So, from our key holdings here, and these are some of the largest companies that we own, a few of them in our top five. We've discussed them, I believe, all in detail over the past couple of months and years. But it's been a good 12 months for all of them, and particularly a good 6 months over the most recent period, especially since November. Uh, what I like about all four of these companies here is that they're all exposed to some sort of tailwinds when it comes to infrastructure stimulus or the U.S. Jobs Act or the U.S. There's IBP, for example, is exposed to the insulation initiatives that they're running in the U.S., i.e., you get a big tax break by installing insulation in your building, clean energy and all that, and energy savings. So, there's a saying, don't fight the Fed. I think equal on the other side is when you see a multi-year stimulus there, don't fight that either. Try to ride it alongside it if you can find good companies that are exposed to in some way. And I think, the bulk of these are, and I think that's part of the reasons why the market's getting excited about some of these. If you look at the company commentary that we heard in the last few conferences we attended, it sounds very, very positive across multiple end markets, whether it's, road construction in the US, infrastructure spending, as I mentioned, home insulation from various tax breaks and so forth. So it's been a good few months. All of these remain reasonable. We've taken some profits there, but 3 out of the 4 of them remain top 5 holdings for us, and still trading on very attractive multiples. It's been earnings upgrade driven more so than just a pure multiple expansion for a lot of these companies. So good earnings, good momentum at the moment.
I see our own government's coming out with they're going to name it something similar to the Inflation Reduction Act in the US.
Yeah, sure.
Really likely to be very inflationary rather than inflation reducing.
No doubt. Near term, at least.
Couple of new stocks in the portfolio, Harvey, and this is probably the largest portfolio weighting wise of them, and also a larger company in terms of market cap as well.
No, that's right. It's one that we brought up in our quarterly report. It hit the top 5, so we had to discuss it. There are a couple of others that are smaller market cap names that we're not quite ready to talk about. We're still in the process of buying and adding to those positions. But this is Fiserv, and Fiserv is a global payments company that provide a wide range of transaction processing solutions to banking and merchant clients. It's actually the 3rd largest payment processor in the world. Maybe not a name that everyday name that people recognize, but it's big. They own and operate Clover, so if you've been in the US, you might have seen those little point of sale systems. Nice little white things you tap your card on when you want to make a payment with nice screen. And their target is small and medium kind of businesses, enterprises. It's a core part of the thesis here. It's growing, expected to grow 30% year on year. It's certainly been growing really rapidly in the US and taking share from various other point of sales companies. Now, Fiserv is a business that has a very, very, very long, 15, 20-year track record of low teens earnings growth, pretty decent capital deployment policies. And, despite this, it's trading at near a 10-year low on a absolute price to earnings multiple and at a very low relative multiple to the S&P 500. You can see that on the bottom right. That is the kind of 10-year premium / discount to the S&P. It's kind of hovering at a minus 20% discount at the moment. Historically, prior to COVID, it did trade at a premium. So while we're not, necessarily saying it should trade there, we certainly think this valuation is too cheap for a business that's got a long history behind it, that's going to grow earnings at least above 10% over the next few years, probably closer to 15, and trading on a very attractive multiple. So we took the opportunity to buy this in over the past few months.
Thanks for that, Harvey. We'll come back in question time. I've got a couple of questions myself about what's happened in these first few weeks of April and how we're preparing for that. But we will move on to the Australian Shares Fund. Alex, it's been a good start to the year there as well, and pretty encouraging reporting season.
Thanks, Steve, and hello, everyone. So, yes, the last 3 months has seen quite a surge in markets, the 3 months to March. We haven't quite kept up with the surge in the smaller ordinaries index there, but have been reasonably close to the All Ords. In the year, despite that, we're up 20%, well clear of both of those. And if you see on the 3 and 5 year horizons there, the small cap underperformance of the All Ordinaries index there is very apparent, where we're above the small and below the all, so still some work to do there. Moving on to the reporting season highlights. We had some highlights and some lowlights to talk about here. Some of the larger stocks delivered some of the better results. RPM was up quite significantly during the period and during the quarter as a whole. It was a good delivery of half-year results. We had 2 upgrades during the half, and I think those results really set the business up to achieve on the full-year guidance that they've set out there, giving people more confidence in that guidance. Highpage is another business that showed the growth that we were expecting despite a more difficult environment for consumers. It is really showing the value that the business provides for tradies here, and that's the really important part of the equation there. And Bravura, another enterprise software business, there has been a new management team in there that's performed probably the quickest and most significant turnaround job that I've seen in the listed markets. And that continued at the half year when the business announced further cost savings, which again showed the earnings potential of the business at the much reduced cost base. It wasn't all positive though. We had on the low light side a couple of software names as well. Phineas, the insurance software business, showed flat revenue and lower run rate revenue, which was disappointing. They put that down to some of the one acquired product specifically with some recurring revenue runoff. They offset that somewhat with better cost control, but it was not a positive result in our eyes. Bigtincan, significant recurring revenue churn and free cash outflow. We've seen since that point a quarterly result that improved a little bit on our perceptions of the February half-year result, but it remains a little bit in the sin bin. And Seven West, a combination of poor TV market revenue and a higher cost base, meant that there was actually a halving of net profit there. We have exited that position since that point.
They're in the media themselves for all the wrong reasons at the moment, Channel 7. A couple of highlights. This is a particularly important one for all investors in the fund, Alex, as the largest investment by some margin.
That's right. And we have been a long-term holder of RPM Global here, and we think they've done a good job in growing revenue from these market-leading mining software products that they have. We're actually up there a couple of weeks ago to look at the products again.
It's a Brisbane-based company, is it, when you say up there?
Yes, that's right. It's a very visual and sort of gamified experience on a lot of their products, and I can see how mining engineers who grew up playing computer games would take very well to products like that. It has continued to grow the sticky recurring revenue that we really see the value in for the business. And it started last financial year, but has continued and will continue into this full financial year, the cost control that the business has put through. So you have a growing sticky revenue line, you have costs that are well under control, and that is a combination for significant operating leverage here. The business has net cash. It's got a buyback in place. Guidance out there shows exactly that operating leverage for the 2024 financial year. And still, despite performing the way it has over the last little while, still a circa 6% free cash flow yield 2 years out when you adjust for the excess cash that the business will have at that point in time.
We've seen a number of takeovers in the tech space, and you and I have long had a view that this was a logical candidate at some point in time. We certainly didn't want it to be too early. How are you thinking about that aspect at the moment?
I think the business is really showing not just the operating leverage component, but that continued growth in that sticky revenue. And that is a very valuable revenue stream. And for some players, it could actually be a very strategic revenue stream. And when you talk strategic revenue streams, you can often think of multiples that are dramatically higher than you would otherwise get. So it's a potential candidate here.
I always say with takeovers, you want another corporate trying to buy your company rather than a private equity firm who cares a lot more about price. New stock in the portfolio as well. We wrote quite a bit about this in the quarterly, which is probably a reflection of how excited we are about the opportunity.
That's right. And I mean, this is a bit of new and a bit of old, because actually the majority of this business will be a new business. So Paragon has been a small position in the portfolio for a while. It was undergoing its own turnaround process, but during that process has now found a partner in CH2. So while Paragon is a distributor of higher end products, CH2 is a distributor of drugs and lower end products. So that is into hospitals, into retail pharmacy, and the business really bringing the two together adds a lot to the combined Paragon Care. It's not just scale, although scale is one part of it. It adds the further management strength because the two shareholders of CH2 will become very large shareholders of the combined Paragon Group, and synergies, which we feel are, while the business has given some indication of what that might be, in our assessment, there may well be more to come. Now, CH2 has already been growing standalone and by acquisition quite substantially over the last little while, especially into this retail pharmacy division, where they've moved to claim quite substantial market share in quite a short period of time. And the nature of this business on the CH2 side is that you grow revenues. Those revenues are quite low gross margin, but your operating costs are, again, reasonably fixed. And so you get a large amount of operating leverage. So that's Paragon. It's climbed to be a larger position as we've added post the merger.
Yeah, very good outcome there. We had our frustrations, and to your point, I think there was already a turnaround going on and a better quality management of that business, but this fixes a lot of problems in one go. It all still needs to go through and be approved by shareholders, but yeah, this time next year it'll be very interesting to be getting a nice clear picture of the combined group.
And a little snapshot here of a portfolio as it stood at the end of March. You see RPM that we've spoken about, ReadyTech, Tourism Holdings, Catapult, and hipages. Businesses generally represented in that top 5 are higher quality, they're larger, and they're growing businesses. And that's been really good to see. The holdings of cash, about 15% there, that really sets us up quite well to take advantage of opportunities, which we have done during the quarter. Quite a lot of new investments being added to the fund, and will continue to, because we have quite a healthy pipeline here of new stocks that we're doing work on.
Thank you, Alex. I'll wrap up with a quick update from my end about the Forager business side of things. Those have been coming regularly to our webinars will know I've been talking a lot about simplifying the Forager business and simplifying the platform that you, our investors, use to invest with us. We're making really good progress on that. We've moved the registry and the responsible entity function for both funds to the same entities, and that is all up and running. A few weeks ago, we announced a meeting of Forager Australian Shares Fund unit holders to consider delisting that fund. We had a question that webinar has been recorded, so if you'd like a copy of it, please send us an email to admin@foragerfunds.com. But the main point here is by mid-2024, we will have 2 products that are on the same platform, that are both priced the same way, that are both open-ended. There's going to be a transition window for that Australian fund, but certainly by the end of the calendar year, we're going to be in a really nice, simple place as a business, and hopefully a much better investor experience for you as clients of ours as well. And we're all really looking forward to getting this behind us and 100% focused on portfolio returns over the coming years as well. As you've seen in today's presentation, the performance rebuild has been underway for some time too, and you'll start seeing that. You're already seeing it in the international fund long-term returns, but it'll start rolling through to that 5-year return for the Australian fund, particularly over the next couple of months as well. We had some horrible months back in 2019 that are going to roll out of that 5-year number. So all the hard work that Alex and Harvey and the team have been putting in on the portfolio side showing some really good results. We'll move to Q&A with that. So as usual, click on the Q&A button at the bottom of the side of your screen and you can start entering some questions there. Harvey, just while people are doing that, I might just kick off with you. It has been a tumultuous start to April, both here in Australia and on global markets. How are you preparing the portfolio and what are you seeing?
Sure. So maybe a bit of color there, but obviously you've had a really strong rally since November. A lot of stocks are up a bunch. You look at Nvidia, that was up over 50% year to date at the end of March. So it's not unusual to see some profit taking and stabilization at those points. But you've had the second sequential increase year on year in year-on-year CPI in the US. So I think that made people a bit nervous. I remember a few months ago people were talking about 5 rate cuts this year. It went to 4, went to 3. Now it's maybe 2. So that's obviously impacting things a bit. In terms of the portfolio itself, we are actually at the highest cash level we've been in quite some time, just over 7%. That's because we want to take advantage of the earnings season and topping up some opportunities. We also took profits and rebalanced certain names that have done tremendously well, where you have had some multiple expansion. So we're just being careful not to overstay our welcome. We still own pretty much all of them, but it's more position size management there. So that's one part of it. And then I think we're, what we've been trying to do over the past few years is pick our spots where businesses can do well, even in tougher cycles and tougher market environments. And I think that we have done that. We have some defensive compounder names in there, a decent chunk of them actually, that they might get hit near term, but on a 1-year view, even in a tougher markets, the businesses should continue to grow. They have pricing power. There's roll-up strategies there. There's various stimulus tailwinds that they benefit from. So I think we feel pretty good about the portfolio, even in trickier environments. That's how I would categorize it. And feel free to chime in with your thoughts as well here, Steve. But I think
Alex, you maybe touched on good, healthy cash levels in the Australian fund as well. From my position as CIO, I will be. I think we've all learnt some lessons from 2021. It all happened very, very quickly. We've talked a lot about it, but we do not want that happening again. No one knows, how much individual share prices go down, but we've certainly put a lot more work into building more resilient portfolios here. And the most important aspect of that is allowing us to take advantage of significant declines if they do come along. Our performance out of those downturns has always been very, very strong. We want to make sure that we do a better job into the bottom as well. Alex?
Maybe just adding a little bit there. I mean, our cash levels have tracked somewhat higher and have actually lifted since the end of the March quarter. That number, I think, positions us quite well. We're in a fortunate position of having stocks that rose quite substantially. We were able to trim and realize some cash as a result of that as they came closer to our target prices. And also, we've had new stocks come in, so that is actually a reflection of a recycling of stocks that have run their course, some where we were getting out of positions which have not worked for us, where we thought it was best to exit, and rotating that into some new ideas that we'll touch on over time as well.
I'll deal with the delisting questions maybe at the end because we've got a few anyway. This is a good one from Peter. Alex, I heard Chemist Warehouse is moving into hospital pharmacy, both wholesale and retail. How much of a threat do you think this can be to Paragon Care?
So Chemist Warehouse is merging with Sigma Group. It will be the larger of the two parties, but it will be a listed entity alongside Sigma. It's a fascinating transaction. Chemist Warehouse was mooted as a IPO candidate for years and years. The business of CH2 that most closely correlates with that is their retail pharmacy supply business of drugs. They have done a good job in growing despite Sigma. And what this will do, the Sigma and Chemist Warehouse merger, is it will cause the 44% of the market that is being held by smaller independent pharmacies to rethink whether they want their their data and their reordering with Sigma to now be visible by their competitor in Chemist Warehouse. And I think that will present a pretty good opportunity for CH2 to continue growing as they already have this retail pharmacy business that they've had.
Yeah, I mean, there's 4 big distributors in Australia, and when this merger, if the merger with Sigma and Chemist Warehouse goes through, 3 of those are going to be very closely aligned with their own retail brands, and CH2 will be the only non-aligned distributor out there. And I think even I caught up with Sigma at a meeting recently. I think even they see CH2. All of the pharmacies have 2 distributors because no one distributor has all of the products. So they'll have a main distributor and a backup one. They really like CH2 as the backup distributor because, again, they don't really want their competitors that are aligned with other retail brands knowing too much information about their business. So in the short term, we think that's a pretty good tailwind. In the medium term, it should be a tailwind. Long term, though, that 44% that's independent probably goes down because Chemist Warehouse has a very, very powerful business model. It genuinely looks like a category killer, which we have seen keep taking market share here in Australia for very long periods of time. So that long-term threat is one worth thinking about, but CH2 for the foreseeable future is in a pretty good strategic place. I don't know whether you want to touch on a couple more, Alex. Certainly not some of the less liquid ones, but Andrew says you mentioned the Aussie fund has added some new stocks in the quarter. Can you share any more names?
We can share one that's come into the portfolio quite recently, and that's the NZX. So the operator of the market over there. So they have, obviously, as you'd imagine, the market's business where they charge companies for being listed, and they take a clip of the trading volume as well as a clip on primary and secondary issuance. I think that business has cyclically turned down somewhat and is quite a nice business to have, and a fixed cost one at that. So we get some of that cyclical recovery that should flow through to earnings. They also have a very strong position in funds management over there, $11 billion worth of FUM in some nice spaces. So they have an ETF business there and a KiwiSaver business. That's quite a quickly growing equivalent to our super system over there. So that's a good position to have. And they also have this wealth technology business that's roughly analogous to a NetWealth or Hub in Australia. But that business has been cash consuming for years and years while they have built that technology out, and now looks to be on the precipice of turning free cash flow positive. So 3 quite attractive elements to the thesis there, and all at a valuation that is particularly attractive given the quality of the business.
Share prices halved there in the past couple of years, sort of 2 Kiwi dollars down to 1, and yeah, interesting new little addition to the portfolio there. Harvey, Neil says, with the international fund, what is the spread between different countries and regions? Do you have a policy on this, or is it just based on individual companies wherever they are located?
Yeah, I mean, we publish this every month and quarter in our reports. As of the latest one, just around 2/3 is in the US, and the rest is spread across Asia Pac, Europe, and the UK. It's not too dissimilar from the MSCI World weightings, to be frank. We do have self-imposed limits on how much we can invest in a specific country or region. So that's a yes on that front. Well, we're always going to be bottoms up. So, if you find a good business, and a lot of these companies that we own tend to be international companies. So, for example, Flutter in the UK is actually international business. It'll show up as a UK weighting there. But from that context, we look bottoms up. If you find a bunch of good businesses and they just happen to be in the same country, and they have some international exposure, and you can limit your economic risk, if it's a small country, I think you can't avoid that when it comes to the US, which drives a lot of stuff internationally. We will go ahead and be overweight a region if we find a bunch of good opportunities there for sure, but within a limit.
Yeah, and I think a general philosophy, there are enough opportunities out there in the world for us to also have some sensible, this is a concentrated portfolio, and it's going to have big moves in terms of performance that are different to the index, but we can get sensible, what we would call long-term business diversification within a global portfolio where we can invest wherever we want. We do have internal limits on countries. If something were to happen where there was a crazy amount of panic about a particular place and Harvey and Gareth were to come to me and say, we've got a 10% limit here on investing in Switzerland, and we think this is the greatest investment opportunity we've seen in a very long time, can we make it 20? And we sit down and have a conversation about that, then absolutely those things themselves are variables that we can change when the opportunities come along. But we try and run the portfolios within the constraints of being concentrated and focusing on our best ideas with a sensible level of diversification as well. Bryn asks where you can find more about the FOR portfolio holdings, not just the top 5. You can't at the moment. And once we are delisted and open-ended, I think we can share more information about that if people get in touch with us. But at the moment, given it's a listed vehicle, we can't do that. We could just disclose more, and we have been considering that. But at the moment, the top 5 is all we disclose. Obviously, anything underneath that is a lower weighting than whatever the 5th one was. Alex, Aussie fund returns for 1, 3, and 5 years, were they based on share price or NAV?
They were based on NAV, Andreas.
Alrighty, we've got a couple of questions here on the delisting when we that we'll get back to by email if that's all right. And just the last one, I'll take this one. We know businesses perform better when management is aligned with shareholders. Can you talk us through fund manager alignment with shareholders at Forager? I own 40% of Forager, and my brother and sister-in-law own another 10, so it's almost half of the company is controlled by my family and have all of my non-house assets invested in our 2 funds. So there's no doubt about the alignment there, but with the rest of the team, we are working and have been for some time on increasing the staff shareholder ownership at Forager, and have a couple of things coming up over the next few months that are going to increase that further. I'd like that number to be up near 70%. We have some very, very useful, experienced external shareholders in this business that help us a lot strategically, but it's the nature of a small boutique funds management business that we want it to be mostly owned by the staff who work here. And the 2 people that are on this webinar today are 2 very important people for the future of this business, and we're working to make sure that they own an appropriate amount of equity in the company to participate in our success and growth in the future. Okay, that will do us. We're down to half an hour this quarter, team. Well done. We want to keep these fairly short and do them more regularly. We appreciate you tuning in, and as always, any questions, send us an email or give us a call here at Forager. Thanks a lot.
Thank you.
Thank you.